CRS, AEOI, CbC SVDP. What do these acronyms mean? How do they connect to each other? And how do they impact on you? The tax transparency and compliance conversation has evolved significantly. The Common Reporting Standard, or CRS, has been introduced as a common standard on the automatic exchange of information, and more specifically of taxpayers' financial information, effectively creating a global framework for information sharing between governments. The purpose? To combat offshore tax evasion and to ensure tax compliance. Governments around the globe have become increasingly aware of the extent of undisclosed wealth that is being held in offshore accounts and that is not being reported for tax purposes. And they are now going after it. And they are doing so through the global collaboration of revenue authorities. In his 2016 budget speech, our Finance Minister reiterated South Africa's unwavering commitment to combating tax evasion on a global level. He gave a stern warning that time is running out for taxpayers who still have undisclosed assets abroad. The introduction of the CRS is sounding the death knell of offshore tax evasion and non-compliance. There is no longer anywhere to hide. In terms of the CRS, revenue authorities globally will be receiving financial information on foreign tax residents and then automatically exchanging this taxpayer information with the relevant foreign revenue authority. For example, if you've invested in the Cayman Islands, the Cayman Islands Revenue Authority will receive your information from whichever financial institution you may have an account with, and will then pass that information on to SARS. The magnifying glass is being applied to all your offshore financial affairs. If you've invested offshore, you can reasonably assume SARS will have sight of all financial information in respect of those investments, and they will be scrutinizing it. What does this mean? If you have any concerns as to your offshore tax compliance, it is now time to regularize your affairs. And what better opportunity to do this than through the SVDP? The South African Revenue Service, together with the South African Reserve Bank, have offered a final opportunity for taxpayers and current and past South African exchange control residents to regularize their tax defaults and or exchange control defaults. This opportunity is called the Special Voluntary Disclosure Program, the SVDP. The SVDP is a 9-month window which runs from 1 October 2016 to 31 August 2017. The SVDP is limited to regularization of offshore assets and exempts income tax, donations tax, and estate duty for qualifying applicants. A tax default includes the failure to disclose income, which would have been subject to taxation in South Africa, but can also include the failure to correctly disclose non-taxable income in South Africa, or misstating information on a tax return. An exchange control contravention arises when South African currency was exported without following the correct authorization channels, or using approved funds for purposes other than that which was stated as the use of the funds during the authorization. Example, the balance of traveller's checks left in a foreign bank account. The excess funds should have been returned to South Africa and sold back to the bank. There are other ways to regularize, using the Permanent Voluntary Disclosure Program, which is a fixed and permanent feature of the Tax Administration Act. One can mix and match your approach in relation to each offshore asset. For example, one can apply for regularization using the Permanent VDP for tax defaults and the SVDP for exchange control purposes. KPMG has a dedicated team of specialists with deep expertise who are able to assist you to regularize your affairs.